Welcome to SOXX Insights. This is our weekly market update. As this week is the beginning of October, we're going to focus on some seasonality checks for stocks, gold, Bitcoin, followed by our usual chart analysis. So looking at the S&P 500, we're using SPY as the ETF. The market is up 15% year to date. It has just been incredibly bid since the beginning of April, since the April low. We are among the top 4 best years in the past 10 years. So a pretty bullish situation. And if you look at the past 10 years returns at this time of the year, SPY is massively outperforming the 10-year average. And in fact, is getting all of the returns that you would normally get by the year end today. And we have been anticipating a seasonal pullback, but it hasn't happened. So typically September is a weak month, but we still got new all-time highs. So the overall market is melting up. Looking at the past 20-year monthly returns as a heat map, we have had inclusively now 5 consecutive months of rises between May and September. It happened in 2024. We had a small flat negative October. It also previously occurred in 2017, and we had a positive month in October, and we haven't really had that many occasions other than this. And then looking at gold is interesting. So the faint lines here are all the historical year-to-date returns for between 2015 and 2024. This year, 2025, is massively outperforming any other year in the past 10 years. We're seeing GLD up 46% year to date, even after a long period of consolidation between April and September. And this is pretty unusual, I would say. The reason it's unusual is if you measure the current bull run against the 52-week low. So this is 52-week low is a rolling number every year. So we are now up 50% from the 52-week low. It's exceeded the COVID high. So if you look at the occasions in which gold has performed this well within the past year, the run-up 2018 to 2020, that was leading up to a major market crash going into COVID. And I know we're going to say COVID is an exceptional circumstance, but back here in 2019, the Fed was cutting rates. We already had inverted yield curve, which was signaling that a potential recession is coming. And it was manifested through the COVID situation. And if you look at 2007 over here, we had a melt up in gold, up 70% from the 52-week low. And remember that 2007 preceded the financial crisis crash, which happened in September 2007. So this could be sending an alarm bell here because it signals that investors are beginning to overhedge the potential recession, potential massive inflation measures that could be triggered by QE. And yet we are in a bull market with GDP growing pretty quickly still, and only the beginning of the weaknesses in the labor market. So this chart is maybe warning us that we don't have that much time left in this melt-up phase of the market, and we could have some sort of hard landing, especially as now the Fed is worried about the labor market. In the not too far future, may not be today, tomorrow, but in a few months' time, we could see that scenario playing out. And looking at gold seasonality, so just putting back into the near-term picture, we've had positive runs in August and September. So September notably up nearly 12%. This doesn't happen too often as well because typically September is a weak month. We've seen that in 2012, up 5% each in August and September, and then down 3% in October. But then 2010, again, up around 5% to 6% in August and September, then up 4% in October. So, and we did have slightly more positive month in September 2007, but we know that we had a big GFC crash subsequently in that year. So this strong demand for gold is a warning, especially when risk assets are going up so much, but investors are still piling in to safe haven bets. Now, looking at Bitcoin, I have to narrow the range slightly to 2020 to 2024 because returns in the previous years were just too high for the relevance of what we're talking about today. We're talking about 1,000%, more over 1,000% returns in a year. So looking at year-to-date returns for Bitcoin, we're actually in the second worst year for Bitcoin versus past 5 years. So up 30% is pretty good for any asset class, but for Bitcoin, we've seen better. So we had one down year in the 5 years prior, but all the other years performed much better than what we've seen today. So at least 50% by the year end, and in some cases more than doubled. Looking at the seasonality again, positive September, that has been the case for the past 3 years now, and they have been followed by a positive October. Again, for Bitcoin prior to 2022, we usually had negative month in September, which we didn't get this time. But October, all of the years except for one, which is 2018, saw positive returns. Pretty good odds. Only 1 out of 10 years saw negative returns. Now, looking at Coinbase, the reason I'm flagging Coinbase now, because it just had a breakout of its sideways channel that it had been consolidating for the past 2 months. And what's unusual about this breakout is for the past 5 days in a row, Coinbase closed higher. That doesn't happen that often. It's happened 17 times so far since it's been listed, and it happened yesterday. So I'm putting out the data of the past occurrences of when Coinbase had a positive streak of 5 greens in a row. And what we've seen is that prior to 2022, which was the bear market, when Coinbase was listed at around 300 and it fell all the way down to $30-ish, we had some bear rallies, which preceded very negative returns in the next 3 to 6 months. But since 2023, every time we've had 5 days of consecutive greens, we pretty much had positive, if not massively positive, returns in the next 3 months and next 6 months. There's only one exception since 2023 for this 3-month period, which is the beginning of 2023. And there was one exception for the 6-month period, which was March 2024. So the odds are pretty favorable for Coinbase to deliver very positive returns in the next 3 to 6 months. And that gives me a bit comfort and confidence that we will see one more high at least going into the year end. And this is the average returns that we put out for since it got listed. The 17 occurrences, 1 month returns forward is 17%, and then 6 month returns is 50%. That's averaging the very bad month back in 2021, 2022 versus the very positive returns in 2023 onwards. So now let's look at the technical analysis. So for SPY, we have been doing this for a while, and the picture hasn't changed that much. We have a very solid trend line supporting SPY that was breached only once intraday since May. As long as we are above this line, we're still going strong in this wave 3 of a larger degree wave 3. And this wave 3 is now approaching the 1.76 extension of this wave 1 here with a very shallow wave 2 pullback. So I suspect next pullback in wave 4 may be a bit deeper just because of the alternating principle between the depth of wave 2 pullbacks and wave 4 pullbacks. But until we breach this line, we can't really say, okay, wave 4 has begun. So we're really preempting when the pullback would happen. Given October, it's generally a very positive month. It could really go even higher, up to 690, which sounds nuts at this point, given where we came from. But in this market, entirely possible. And so far, these returns have been linear. So it's been moving up in a fairly linear trend. But we've seen in stocks like Oracle more recently, the market in those single stocks have been more parabolic, so more exponential. We are going to just keep track of what we had. So the big picture hasn't really changed that much. So if you are bearish, a lot of investors are purchasing large amount of puts. So puts are getting quite expensive. So, but that is a very valid way of hedging. Or you could start buying some inverse ETFs alongside your normal position and take advantage of the potential crash when it happens. Or you could set trading stops against this trend line or even the 50-day moving average and just take profit when the market starts to draw down. QQQ is very similar. It had a slightly steeper pullback over here, but the overall picture remains bullish as long as we're above 50-day moving average. Is really hard to say that a wave 4 pullback is about to begin. So I will just stay with the trend, bull market, trade with momentum right now, and start putting in the hedges or at least some trading stops. When the market starts pulling back, you can lock in the profit you've earned in the past few months. For bonds, we have been bullish since this breakout. We had a breakout and retest of this trend line from a while back. So now I do think we are heading towards wave 5, and wave 5 can land anywhere above $92. And this will be mostly driven by the sentiment that the Fed is focusing on the labor market and going to cut rates more aggressively than they had previously suggested. So I would say on the margin, the Fed is decidedly more dovish. If you read what they say in these speeches, instead of saying the inflation is still a big concern, they have concluded 3 things. First, the tariff impact should be one-off, so therefore inflation should be transitory. Second, over time, inflation should be coming down towards the target without needing a higher base of interest rate. And thirdly, this is the beginning of the Fed moving towards a more neutral rate, which many economists would estimate to be around 3% range, given where we are in terms of inflation. And overall, the Fed is really more concerned about unemployment, because when unemployment starts moving up, it can move up quite quickly. And that is very negative to growth and GDP. And perhaps that is something the gold market is signaling right now. Looking at Bitcoin, so I am currently a little bit more cautious than probably you will hear from other people. And the reason is this: we had a very steep pullback at the end of September. And now this rally here has only stretched to about 100% and below the 1.236 extension of this wave A. So for me to think this is a 1-2 setup for wave 3 higher, I want to see Bitcoin breaking above the 122 mark to decidedly invalidate this wave B count. So until that happens, I am going to put this ABC and wave B as a very valid expectation. So the market has to prove to me that we haven't topped in here and we are going to see one more high or even more highs from this point onwards. I do think, combined with seasonality, this alternative path of 8123 waves onwards towards one more high towards 130k is a very valid alternative. It could happen. I just want the market to show me this path and confirm it instead of trying to preempt too much. With Ether, I have taken a long look at this chart and really start thinking about what makes sense in terms of the waves and the technical setups. We're still well within this upward channel. And this consolidation here actually looks very similar to the consolidation we had in May. So that is a pretty positive pattern, repeatable pattern here. It suggests we could go higher and travel towards the 6,000 or even 7,000 mark. And what I have found the best count here so far is potentially a 1, 2, and then a nested 1, 2, 3, 4, 5 waves inside a higher degree wave 3. So I think for me, that count would make most sense. So the next part would be likely a wave 5 higher into the 6,000 region. Solana, I am actually a bit more cautious now because of the extent of this pullback. In terms of the overall bullish structure, it didn't make too much sense for an impulsive move, because if this is wave 3 and wave 4, and wave 4 is a little bit too steep for against wave 1, so it hasn't breached yet, but the wave 3 is quite shallow and this pullback is also quite steep. So overall, there are two options on the table right now. First, we are looking at the wave 1 and wave 2 pullback here, and this is part of a ending diagonal structure where wave 3 is barely above the length of wave 1 with a steeper pullback in wave 4 that could challenge, that could step into the wave 1 territory. And we are not going to see as high as wave 5 as I previously expected. So I don't have a placeholder for wave 5 yet. I want to see how this wave 4 corrects. If this is, so you could try to pin this down as a 1, 2, 1, 2 setup. But in reality, if this is a 1, 2, 1, 3, 4 inside a larger wave 3, this overlap doesn't make sense. It shouldn't happen in larger wave 3 because this is typically at the beginning of a cycle. So wave 1 as a leading diagonal, or the end of a cycle, wave 5. It's just the momentum isn't quite as strong as you would have in wave 3. So I'm ruling this out as a nested pattern inside a larger degree wave 3 here. And also, I'm quite cautious that we've had a all-time high back in Jan. We have not approached that new high or broken that high yet. So this very well could be a wave B and wave C corrective pattern, where this is a large degree wave B instead. And what that means would be this is wave 3 top, and then wave 4 would be all the way down here with one more leg down in wave C. So I think there are more alternatives here, leaning towards the bearish options for Solana. And I understand that, yes, when the crypto market goes up, they tend to go up as a whole. But in the past 2 years, we've seen a separation of institutional investors who are investing the ETFs, IBIT, ETHA, and the treasury companies like Strategy, SPED, and BMNR more recently, versus the rest. So even Solana doesn't have as many good ETFs or treasury companies going for them. So they are more in the alts region. And if you look at the trading volumes on Coinbase, which this provide every quarter, Solana is neck and neck with Ripple. Sometimes it's not even the top 3. Sometimes Ripple is. So I would say Bitcoin, Ethereum are in their own class, and Solana, I'll be a bit more cautious in terms of the bullish expectations.
Coinbase, so I re-examined this chart a bit more closely. We've had wave 1 and wave 2, and I think this is a wave 3 with 1, 2, 3, 4, 5 subwaves that I haven't labeled here. Previously, the danger was that we have 5 waves down that could take us to one more low. This rally out of this channel range has invalidated that one more low expectation. So now, where we are today is a little bit similar to Bitcoin. So we have a wave 2 here, but that could also easily be a wave A and wave B and wave C corrective rally for the past week. And the reason is that wave C is typically 100 to 123% extension of the first wave. So until we've exceeded the 390 mark, we can't really completely remove the potential for this being a wave B rally and therefore wave C one more low subsequently. So that is definitely in place, but I would just mention a bit more about the potential bullish structure here that is on the table. So you can think of the current structure a little bit similar to Bitcoin, but we're focusing on the bullish potential here. So I think if this is wave 1 and wave 2 low, we could easily exceed 430 to even 450 in this next run for wave 3, for pullback, and ultimately wave 5 could be in the mid 500s. And typically, if you think about this larger degree, wave 5, it is the 130% plus extension, inverse extension of this wave 4. So this is a very typical zone for wave 5 that could land anywhere between 520 onwards to mid 500, even high 500s. But this is on the premise that we've had a 1-2 setup rather than an A-B setup so far. So so if you want to take this bullish thesis and execute based on this, I would say risk manage accordingly. If we're targeting somewhere in the 420 to 440 region, ideally we want to wait for an entry near the 50-day moving average, the 330s, and with the stop loss below this end of this channel. That would give us a bit better risk reward than just buying in here and chasing the trade.
Robinhood, very bullish in the past month, is hitting our wave 5 target, now stretching to the top of the wave 5 region, which is 140, to stretch to 150. But going beyond here, I'm not chasing. I'll be watching for the next pullbacks. Even if we're in more nested, extended run in this wave 5, I still wouldn't want to chase it given the risk reward. Looking at gold, I do think gold will see some sort of pullback soon. It's been slightly parabolic since end of August. The good thing is we actually flagged this potential back in July and August. We've been watching. It was getting really boring for about 3 months, and we're just mapping out the potential path. And this path here was exactly what we had in mind back in July. So if you caught this wave, you would have done very well in the past 6 weeks. So now hitting this target, could we see it stretch? I think it's getting quite tough without a near-term pullback here. And I would just certainly not chase. I think if it pulls back here, I think depending on the structure, we could think of a setup going to the next wave 5 high. But for now, I'll stay calm and just watch the market game. Apple has been a little bit boring, consolidating in a very narrow range, around 250 in the past week or so, or even 2 weeks. I do think we should push for one more high in this wave 3 to 265 at least. And the overall uptrend is still very much intact, very strong. And what I can see is that Apple starting to announce more aggressive capex, or if they're not going to do that, they're going to announce more aggressive shareholder buybacks, because they'll have to do something with their cash more aggressively one way or the other. And I think Apple tactically wants to make more acquisitions in that sense. So if they're not doing more capex or shareholder buybacks, they would have to buy an AI company of some sort. And yes, developing using third-party AI models like GPT or even Gemini, it could be cost saving in the near term, but Apple has been famously wanting to do everything within their own ecosystem. They haven't done a good search engine, I would say. Probably with that's the only exception. If they want to get an AI native ecosystem going, especially with App Store and their hardware, they need their own AI. And so the next catalyst that would help Apple higher would be something along the lines of investing more heavily in AI, whether through higher capex or an acquisition offer somewhere. Amazon, so we have been spotting this downtrend here as a potential wave C. And so that would have saved us a little bit of money, breaking down the wave 5, breaking down the 50-day moving average. So the question here is, this bounce here, is that wave 4, or have we actually even finished wave 5? It's a little bit unclear right now. There is a heavy volume profile in this region for support. So I would say, instead of us preempting whether we've bottomed already, let's just wait for the price action to confirm it. We get above the 50-day moving average, we could say this is the bottom. If we are seeing challenge below this, I think one more low is coming. Google, we've had a very shallow pullback so far in the past 2 weeks. I lean towards a slightly heavier pullback to test this trend line here. That was the top of this channel going from the April low. And that would put us into a decent buying opportunity at 230. The valuation is still pretty good at those levels. And if you're patient, you could wait out for the 50-day moving average to be tested too. So it's hard for me to see Google or Alphabet moving significantly below the 50-day moving average. So you just have to pick your spot. I do think there will be one more high in this wave 5. But the exact target is when we see the wave 4 forming more concretely here before we pin on the larger degree. Meta. So the dilemma with Meta is that we've had a ABC correction and the wave C has entered our target zone. So technically it has sufficient length to consider as complete. And I think we've called Meta pretty well in the past couple of months, saying this could be a wave B, the ABC 3-wave structure over here, and a lower low for wave C. So now I do think this is a compelling buying zone in terms of this wave C having completed, potentially with wave 4 being here, and then one more high in wave 5 that could travel to a 50s range. So the risk reward is pretty good, about 4-1 if you enter here and put a stop below this green box, or even a bit wider at the 1.382 extension of this wave A, just in case this is a larger degree wave 3 of some sort to the downside. So the challenge is our machine learning model hasn't been convinced yet that this one-day bounce is sufficient to say we are starting wave 5. So we have been risk off in terms of machine learning. The machine does want to see more evidence of a sustained positive price action before saying, okay, we can enter now. So you could be a bit early. So there is a bit higher risk versus the reward. But for more concrete opportunity, you could wait for the machine learning signal or even just wait for the 50-day moving average to be met as well. Microsoft, my suspicion is that we are in a wave C up of this wider degree wave B, and we could see wave C lower. Just zooming out, we did tap the 0.236 retrace of this wave 3. So there is a decent length for this wave 4 to consider as complete, but that combined with where we are in terms of valuation, machine learning model, I don't see Microsoft as a compelling buying opportunity just yet. So if we do get a wave C down, we can examine more closely on if the overall picture looks more sensible to enter for a final wave 5 high. NVDA, so NVIDIA has capped the 1.236 extension of this wave A at 190. So I did say that if we break above this level, we could consider wave 4 completed, and then we can say this potentially is a 1-2 setup and then now we could be in wave 3. We haven't quite got there yet, but the odds are shifting more favorably for NVIDIA for sure. So either we complete this and we have a lower low in wave C for this wave 4 to be considered complete, or if it stretches directly higher from here, then we can move this wave C expectation off the table and start focusing on wave 5. It doesn't mean the market can go up or down. It means that we want to see what the market does next to validate our bearish or bullish thesis. And once we validate this thesis, we know where we are in the wave and where we are likely to go in the next part of this journey. So Tesla, I did worry that we get a sell the news factor. I have been warning this for about a week. 497,000 vehicles delivered, so pretty good quarter, thanks to the EV credit expiring on 30th of September. So if you put a deposit down and made the order, you actually were eligible for the EV credit before the 30th September. The question now is, on the fundamental side, how far will robotaxi scale in the next quarter and next 6 months? So robotaxi is really what's driving the value of Tesla. And secondly, because we've got a spike of orders due to the EV credit, what's unacceptable as the Q4 delivery going down from here. So going from 500K almost to 350, maybe that's unacceptable, and the stock will crater because of that, even though the majority of the value comes from the future promise of the robotaxi. There are still a lot of investors or sentiment being locked around the quarterly deliveries too. So that's the fundamental side. And on the technical side, how deep will this wave 4 get? Because this wave 2 was pretty steep, I actually expect a fairly shallow wave 4. So I think we can test 420 in this pullback. That will be the shallow end, and unlikely below 390, which is 0.38 retrace of this wave 3. So my expectation is we tap 420 and we move higher into wave 5. And this is a preliminary placeholder, but I think 430 onwards, even 550 is a realistic target, especially as we break above this all-time high from December 2024. So a pullback and a higher high is my current expectation. Finally, Palantir, pretty bullish uptrend from here, is seeing a bit of resistance at this wave 3 high, which was built in August. But overall, I do think we will complete wave 5 at above 210. So a lot of people, if they shorted over here and got the benefit below the 50-day moving average, and they ideally should have taken profit during this consolidation phase. If they didn't, they should set a stop loss on what they can accept as a loss, because it's Palantir. SOXX extremely bullish run in the past month, seeing new local highs, and we are way above this all-time high as well. It just couldn't seem to go down. We're in a stretch territory, so I'm not chasing it here. And to be honest, until we see concrete breakdown of the levels, I wouldn't even bother mapping out where wave 4 can go. So I will just watch, and maybe we can get a wave 4 target when it starts correcting next week, the week after. Stay patient on this one. That's it. Thank you very much for joining me this week. Let's catch up next week.